You walk into a fancy bank building with marble floors and people in expensive suits talking about something called hedge funds. They're using big words and nodding seriously like they're discussing the secrets of the universe. Meanwhile, you're wondering if you should put your allowance money somewhere that sounds this important. Today, I'll explain why Wall Street loves hedge funds, but why ordinary people like you and me should probably just stick to index funds and ETFs like you're 5 years old. And by the end, you'll understand why the fancy investment world isn't always the best playground for regular folk. Here's what you need to know right up front. Hedge funds are like expensive, complicated machines that promise to make you rich but rarely deliver results worth their high costs. Index funds and ETFs are like simple, reliable tools that just steadily help your money grow over time. Wall Street loves hedge funds because they generate massive fees and trading activity. But for regular people saving for retirement or building wealth, the boring, simple approach usually wins. Let me show you why. First, what even is a hedge fund? Maybe you have a really smart friend who says they can take everyone's lunch money and turn it into more lunch money by doing really complicated trades and tricks. That's a hedge fund manager. They collect money from lots of people, but not just anyone, only people who already have tons of money, like millionaires and billionaires. It's a super exclusive club where you need to already be rich to play. These managers use fancy tricks to try and make your money grow faster. They make bets that a company's stock will go down instead of up, which is called short selling. They might borrow money to buy even more investments, hoping to multiply their returns. This is called leverage, and it's like using your friend's allowance to buy more candy, hoping you can sell it for enough to pay your friends back and keep some profit. They might trade currencies from different countries or use super fast computers to buy and sell things in milliseconds. Some hedge funds even invest in weird stuff like weather derivatives or bankruptcy claims. It's like juggling while riding a unicycle while solving a math problem. Some people can do it, but even the experts sometimes mess up spectacularly. Now compare that to index funds. An index fund is like a big basket that holds tiny pieces of lots and lots of different companies. Instead of trying to pick when companies will do best, it just buys a little bit of everything. It's like instead of trying to guess which kid in your class will get the best grades this year, you just become friends with everyone and celebrate when the whole class does well. The most famous one tracks the S&P 500, which is just a list of the 500 biggest companies in America. When you buy this index fund, you own a tiny piece of Apple, Microsoft, Amazon, Google, and 496 other companies all at once. You don't have to guess which one will win because, well, you own all of them. ETFs, or exchange-traded funds, are basically the same thing, but you can buy and sell them more easily during the day. They don't try fancy tricks. They just buy and hold pieces of lots of companies and let other companies' success make your money grow over time. So why does Wall Street love hedge funds if index funds are simpler and better? The answer is money. Lots and lots of money. When you give your money to a hedge fund, you pay them just for trying, whether they succeed or fail. Most hedge funds charge 2 and 20. 2% of all of your money every year just for holding it, plus 20% of any profits. So if you give them $100, they take $2 right away, every year, whether they make you money or lose it. If they somehow turn your remaining $98 into $110, they take 20% of that $12 profit, about $2 more. You end up with maybe $106 while they keep $4 of your original $100. That's a pretty sweet deal for them. Index funds, though, they might charge 0.03% per year. That means if you invest $100, you pay 3 cents per year instead of $2 or more. Over many years, this difference can mean thousands of extra dollars in your pocket instead of theirs. Wall Street also loves hedge funds because they create tons of trading activity. Every time someone buys or sells something, banks and brokers make money from the transaction. Hedge funds trade constantly, which means lots of fees for Wall Street. Index funds just buy and hold, so there's really not much action to profit from. Plus, hedge funds make people on Wall Street feel smart and important. They get to use fancy words like long-short equity strategies and quantitative arbitrage at cocktail parties. Everyone nods like they understand, even though most people have no idea what any of that means. Here's the really crazy part. Despite all the complexity and expensive fees, most hedge funds don't actually beat simple index funds over the long term. Study after study has shown this. One famous example is when Warren Buffett, one of the greatest investors ever, made a bet in 2008 that a simple S&P 500 index fund would beat a collection of hedge funds over 10 years. He won easily. The index fund returned about 125%, while the hedge funds averaged only 36%. And remember, Buffett picked this bet knowing that he'd probably win. If hedge funds were so great, he never would have made the wager. It's the tortoise and the hare story, but with money. Hedge funds are like the hare, running around doing complicated things, sometimes sprinting ahead, but often getting tired or running in the wrong direction. Index funds are like the tortoise, slowly and steadily moving forward. And most of the time, the tortoise wins. But why does this happen? First, those expensive fees add up over time, like compound interest in reverse. Instead of your money just growing and growing, the fees shrink your returns year after year. It's like a piggy bank with a hole in the bottom. Even if someone keeps adding coins, you're still losing money through that hole. Let me show you with real numbers. Say you invest $10,000. With a hedge fund charging 2% per year, you pay $200 annually just in management fees, plus 20% of any gains. With an index fund charging 0.03%, you pay just $3 per year. After 30 years, assuming both investments grow at 8% before taxes, the hedge fund investor ends up with maybe $60,000 while the index fund investor has nearly $95,000. That's $35,000 extra dollars just from avoiding high fees. Same starting amount, same market performance, wildly different outcomes. Second, predicting which stock will go up or down is incredibly hard, even for super smart people with fancy computers. The stock market is like weather controlled by millions of people making decisions simultaneously. Some of them robots, some decide based on what they had for breakfast. Even if you're right more often than not, you might not be right enough to overcome those fees. Third, when hedge funds do well, it's often because they took big risks. Sometimes those risks pay off and everyone thinks the manager is a genius, but sometimes they backfire spectacularly and people lose everything. It's like a gambler who wins big one night and then loses it all the next. The wins get attention, but the losses can wipe out years of gains. Index funds avoid this by not trying to be heroes. They spread your money across hundreds of thousands of companies, so if some do badly, others doing well can balance it out. It's like having a diverse group of friends instead of putting all your social energy into one person who might move away. This strategy is called diversification, and it's one of the few free lunches in investing. You reduce your risk without reducing your expected returns. When one company has a bad year, it barely affects your overall investment because it's just 1 out of 500. When one company has a great year, you benefit from that too. You're not betting on individual winners, you're betting on the entire economy growing over time, which is a much safer bet. For regular people, there's also the access problem. You can't even invest in most hedge funds unless you're already a millionaire. They have minimum investments of hundreds of thousands or even millions of dollars, and you need to prove that you're sophisticated enough to handle the risks. Index funds and ETFs, you can start with just a few dollars in any regular investment account. No special requirements, no proving yourself. Index funds are also dead simple to understand. You don't need to trust that some manager is smarter than everyone else. You don't need to understand complicated strategies or worry about whether your fund manager is having a bad year. You just need to believe that over time, business in general will grow and become more valuable, which they have for hundreds of years. This is a much easier thing to believe than this one person can consistently outsmart millions of other investors in sophisticated computer algorithms. You can check how the S&P 500 is doing any day of the week. You can see news about the companies you own. You know what you're invested in and why. With a hedge fund, you're basically handing your money to someone and hoping that they're as smart as they claim to be. You might get quarterly reports with fancy charts, but you're not really in control or able to verify what's happening. It's the difference between driving your own car and being blindfolded in someone else's car while they tell you they're a great driver. There's also the transparency issue. With an index fund, you know exactly what you own. If it's an S&P 500 fund, you own pieces of those 500 companies. You can look up exactly which ones and how much of each. With hedge funds, the strategies are often secret. You might not know what you actually own or what risks you're taking. You're just trusting someone to handle your money in ways that you can't see or understand. Oh, and taxes do matter as well. Hedge funds trade frequently, buying and selling throughout the year, and every time they sell something for a profit, that creates a tax bill passed to you. Index funds usually just buy and hold for long periods, which means fewer taxable events and more money staying in your pocket instead of going to the government. But what about when hedge funds do really well? Well, don't some make huge returns? Yes, some do. Sometimes. But here's the problem. You can't know which ones will do well ahead of time. It's like picking lottery numbers. Sure, someone wins every week, but you can't predict who. And for every hedge fund that does amazingly well in a given year, many others do poorly or just okay. Even if you could somehow identify the best hedge funds, they often don't stay the best. A brilliant manager last year might make terrible decisions this year. Markets change, strategies stop working, and geniuses turn out to be lucky. There's actually a phenomenon where hedge funds that do extremely well often attract so much new money that they can't maintain their strategy anymore. It's like a great small restaurant that becomes so popular it has to expand into a huge cafeteria and loses what made it special in the first place. Success becomes its own worst enemy. Meanwhile, index funds keep doing their boring, steady thing. They don't try to be stars, so they don't have spectacular failures. They don't depend on one person being brilliant, so they don't fall apart when someone makes bad decisions. Since 1926, the US stock market has returned about 10% per year on average, including dividends. Some years are up, some years are down, but the long-term trend is clearly upward. An index fund captures that entire trend without trying to be clever about it. The bottom line: the most regular people saving for retirement, buying a house, or building wealth for their families. Index funds and ETFs offer a much better combination of low cost, simplicity, and good long-term results. They're that good old reliable friend who always shows up when they say they will, not the exciting friend who might take you on an amazing adventure or might leave you stranded. So let's recap this Wall Street adventure. Hedge funds are complicated, expensive, exclusive investments that make Wall Street rich through massive fees and constant trading. Index funds and ETFs are simple, cheap, accessible investments that let your money grow steadily over time. Wall Street gets excited about hedge funds because of the money they generate in fees, but regular people usually do better with the boring approach. And now go forth and invest wisely. Your future self will thank you for choosing substance over flash.